Welcome once again to our commerce classroom. In this session, we will discuss about accounting for taxation. Tax accounting is basically accounting for taxation purpose. In most of the cases, the tax accounting rules differs from generally accepted accounting principles. In tax accounting, we follow certain methods and policies at the time of preparation of tax returns and other statements for complying with the tax laws. In most of the countries, there are framework and guidelines for arriving at a taxable profit, which differs from accounting profit or book profit. The variation in taxation rules and generally accepted accounting principles leads to the generation of deferred tax assets and deferred tax liabilities. We know for computing accounting income, we follow generally accepted accounting principles. Accounting income is equal to accounting revenues minus accounting expenses. Taxable income is the net income calculated in accordance with the tax laws. We know taxable income is equal to taxable revenues minus tax deductible expenses minus tax exemptions. I repeat, taxable income is equal to taxable revenues minus tax deductible expenses minus tax exemptions. Then current tax. We calculate current tax by multiplying taxable income into tax rate. We know corporation tax or income tax, as it recognized in Ind AS 12, is normally shown as an expense in our profit and loss account. Income tax is payable by a company on its total income. Income tax as per Ind AS 12 and IAS 12. We discuss about it. Income tax consists of two parts, current tax and deferred tax. As per accrual concept, the income tax must be accrued in the accounting period in which income is earned, and tax benefits must be recorded in the accounting period in which expenses are incurred. But tax payable is calculated as per Income Tax Act 1961. The taxable profit calculated as per Ind AS and income tax laws may differ. The tax calculated as per income tax rules of the country is known as current tax. I repeat, the tax calculated as per income tax rules of the country is known as current tax. To confirm the accrual concept, Ind AS 12 requires companies to create deferred tax. Repeat, to confirm the accrual concept, the Ind AS 12 requires companies to create deferred tax. For income tax purpose, Ind AS 12 classifies tax into two, current tax and deferred tax. Current tax, it is the tax arises due to transactions of current period that are recognized in entity's financial statement. Deferred tax, it has future tax consequences. It arises due to the recovery of carrying amounts of assets or settlement of carrying amount of liabilities that are recognized in our entity's balance sheet. I repeat, current tax is the tax arise due to transactions of current period that are recognized in entity's financial statements. Deferred tax has future tax consequences. It arises due to the recovery of carrying amount of assets or settlement of carrying amount of liabilities that are recognized in our entity's balance sheet. Then we discuss about certain basic concepts of current tax and deferred tax. Firstly, accounting profit. It is the profit or loss for a period before deducting tax expenses. I repeat, accounting profit. It is the profit or loss for a period before deducting tax expenses. Then second term, taxable profit or loss. It is the profit or loss of a period computed as per Income Tax Act. Taxable profit or loss. It is the profit or loss for a period computed as per Income Tax Act. Then our third term, tax expense or income. It is the aggregate amount included in the determination of profit or loss for a period in respect of current tax and deferred tax. I repeat, tax expense or income. It is the aggregate amount included in the determination of profit or loss for a period in respect of current tax and deferred tax. Then fourth term, deferred tax liabilities. These are the amount of tax payable in future periods in respect of taxable temporary differences. I repeat, deferred tax liabilities. These are the amount of tax payable in future periods in respect of taxable temporary differences. Then our fifth term, deferred tax assets. These are the amount of tax recoverable in future periods in respect of deductible temporary differences, carry forward of unused tax losses, carry forward of unused tax credits. I repeat, deferred tax assets. These are the amount of tax recoverable in future periods in respect of deductible temporary differences, carry forward of unused tax losses, carry forward of unused tax credit. Then the sixth term is temporary difference. It is the difference between carrying amount of an asset or liability in the balance sheet and its tax base. I repeat, temporary difference is the difference between the carrying amount of asset or liability in the balance sheet and its tax base. The temporary difference may either be taxable temporary difference or deductible temporary difference. Taxable temporary difference, TTD. In future, at the time of settlement, that will result in taxable amount. I repeat, taxable temporary difference. In future, at the time of settlement, that will result in taxable amount. Then second one, deductible temporary difference, DTD. In future, at the time of settlement, that will result in the deduction of taxable amount. I repeat, deductible temporary difference. In future, at the time of settlement, that will result in deduction of taxable amount. Then our seventh term is tax base. It is the carrying amount of an asset or liability for tax purpose. I repeat, tax base is the carrying amount of an asset or liability for tax purpose. Then we discuss about recognition of current tax liabilities and current tax assets. According to IAS 12 or Ind AS 12, any unpaid amount in respect of current or prior periods shall be recognized as current tax liability. According to IAS or Ind AS 12, any unpaid tax in respect of current or prior periods should be recognized as current tax liability. If the tax paid in respect of current or previous periods exceeds the amount due for those periods, the excess shall be recognized as current tax assets. I repeat, if the tax paid in respect of current and previous periods exceeds the amount due for those periods, the excess shall be recognized as current tax assets. Then we explain it with the support of an example. In 2019, X Limited has a taxable profit of rupees 3,20,000. In the previous year 2018, income on 2018 profits had been estimated as rupees 70,000. Any under or overpayments are not settled until the following year's tax payments is due. What would be the tax payable and the charge for 2019 if tax due on 2018 profit was subsequently agreed with the tax authorities as rupees 80,000 or rupees 60,000? Assume 30% tax rate. Calculate tax charge and liability. Then our solution is this. Our first case, if tax due on 2018 profit is 70,000. Our tax for 2019 profit is equal to 3,20,000 our profit into 30% tax, that is equal to rupees 96,000. Then in 2018, we have underpayment of tax. Our estimation 70,000 and income tax authorities permitted 80,000. Income tax authorities calculated 80,000. So in the year 2018 we have underpayment of tax. we have to add it. Underpayment 80,000 minus 70,000, that is equal to 10,000. So tax charge and liability is equal to current year's tax liability 96,000 plus underpayment of 2018 10,000, that is equal to 1,06,000. Then our second case, if tax due on 2018 profit is rupees 60,000, we know our current year's tax 2019 tax, our profit 3,20,000 into 30% tax rate, that is equal to 96,000. In 2018 we have overpayment of tax. Income tax authorities estimated, calculated only 60,000, but our estimation was 70,000. So 70,000 minus 60,000, we overpaid 10,000. Then at the time of calculation of tax charge and liability, we can deduct this 10,000 from our current year's tax liability. So tax charge and liability is equal to 96,000 minus 10,000, that is equal to 86,000. Then we discuss about the term tax base. We know tax base is the amount at which the assets or liabilities are valued by income tax authorities for tax purpose. I repeat, tax base is the amount at which the assets or liabilities are valued by tax authorities for tax purpose. Then an example, a machine cost is rupees 100. Book value of machine rupees 80. That 80 comes cost rupees 100 minus accumulated depreciation rupees 20. Then for tax purpose, depreciation of rupees 30 has already been deducted and the remaining carrying amount of rupees 70 will be deductible in future periods. In that case, our tax base of machine is rupees 70. Then we discuss about difference in accounting profit and taxable profit. There are two reasons for differences: permanent differences and temporary differences. Firstly, we discuss about permanent differences. Permanent differences occur when certain expenses or incomes are excluded from the computation of taxable profits. Example, entertainment expenses, non-qualified donation under section 80G. Such expenses are allowed in the books of account in the year of payment, but it is not allowed in income tax in the year of payment or on any coming years. So this difference is permanent in nature and hence they are ignored. Then we discuss about temporary differences. The main reasons for differences between accounting profit and taxable profit are difference in the computation of depreciation as per Income Tax Act and Companies Act, disallowance of certain expenditure under Income Tax Act, but which allowable in subsequent years on payment basis. A temporary difference is the difference between the carrying amount of an asset or liability in the balance sheet and its tax base as per tax. But this difference is temporary in nature and going to be settled in subsequent years. Then we discuss about types of temporary differences. Temporary differences may be either taxable temporary differences or deductible temporary differences. Temporary differences may be either taxable temporary differences or deductible temporary differences. Taxable temporary differences, TTD. A taxable temporary difference is a temporary difference that will yield taxable amount in future when carrying amount of asset or liability is reversed. I will repeat, a taxable temporary difference is a temporary difference that will yield taxable amount in future when carrying amount of asset or liability is reversed. Example, sale of goods. Revenue is included in accounting profit when goods are delivered, but included in taxable profit when cash is received. Then deductible temporary difference, DTD. A deductible temporary difference is a temporary difference that will yield amounts that can be deducted in future when carrying amount of asset or liability is settled. I will repeat, a deductible temporary difference is a temporary difference that will yield amounts that can be deducted in future when carrying amount of asset or liability is recovered or settled. Example, research costs are recognized as expense for accounting purposes, but are not deductible against taxable profit until a later period. Then we discuss the term timing differences. A temporary difference which originate in one period and are capable of reversal in one or more subsequent periods are known as timing of differences. I repeat, a temporary difference which originate in one period and are capable of reversal in one or more subsequent periods are known as timing of differences. Then we discuss about the term deferred tax. Deferred tax is a tax calculated for temporary difference between taxable profit and accounting profit. The temporary difference can either be a tax liability to meet in future or tax asset. A temporary difference can either be a tax liability to meet in future, that means save tax now, pay tax later, or a tax asset, that means pay tax now, save tax later. Then deferred tax liability. When the accounting profit is more than taxable profit, it means we pay less tax now because our taxable profit is less, but we have to pay more tax in future. I repeat, deferred tax liability. When the accounting profit is more than the taxable profit, it means we pay less tax now. Reason, our taxable profit is less, but we have to pay more tax in future. Then an example, a company 30% tax rate sold goods worth rupees 2 lakh to a customer, but it receives payment from its customer on installment basis over next 4 years with rupees 50,000 annual payments. Company recognizes rupees 2 lakh as revenue in the financial statements while it records only rupees 50,000 based on installment method for tax purposes. This results in temporary difference of 1,50,000, the 2 lakh minus 50,000. That company expects to liquidate this 1,50,000 within the next 3 years. So the deferred tax liability of the company is, we know, 1,50,000 into its tax rate 30%. 1,50,000 into 30%, that is equal to 45,000. 45,000 is the deferred tax liability. The company records this deferred tax liability of rupees 45,000 on its financial statements. Then deferred tax asset. When the accounting profit is less than taxable profit, it means we pay more tax now because our taxable profit is more, but we have to pay less tax in future. I repeat, deferred tax asset. When the accounting profit is less than taxable profit, it means we pay more tax now. Reason, our taxable profit is more, but we have to pay less tax in future. Example, accounting income is rupees 8 lakh and taxable income is rupees 12 lakh. Suppose our tax rate is 30%. Here, temporary difference 12 lakh minus 8 lakh, that's equal to 4 lakh. So deferred tax asset is 4 lakh into 30%, 1,20,000. Then we discuss about measurement of deferred tax assets and liabilities. Deferred tax assets and liabilities shall be measured at tax rates that are expected to apply to the period when asset is realized or liability settled, based on tax rates that have been enacted or subsequently enacted by the end of the reporting period. It may be noted that deferred tax assets and liabilities should not be discounted. Then about revalued asset. Under IAS or Ind AS 16, assets may be revalued to show at their fair value. The revaluation of assets doesn't affect the taxable profit in the period of revaluation. As a result, the tax base of the asset is not adjusted. Then, temporary difference of the revalued asset will be the difference between carrying amount of the revalued asset and its tax base. This gives rise to deferred tax asset or liability. An example, a company revalues its plant property and equipment on 1st April 2017. The details are as follows. Carrying value of asset rupees 50,000. Fair value of asset revalued rupees 1,20,000, tax base rupees 50,000. The assets are depreciated at 30% in books, straight line basis, and are depreciated at 30% for tax purposes. Calculate deferred tax asset or liability. Assume 50% tax rate. Then our solution. Taxable temporary difference on 1st April 2017. We know 1,20,000 minus 50,000, that is equal to 70,000. So our deferred tax liability on 1st April 2017, that temporary difference into tax rate 70,000 into 50%, that is equal to 35,000. Then journal entry on 1st April 2017, we have revaluation surplus. Revaluation surplus, debtor 35,000 to deferred tax liability 35,000. Then on 31st March 2018, written down value of asset 1,20,000 minus 36,000, that is equal to 84,000. 1,20,000 minus 30% depreciation, 1,20,000 minus 30%, that is equal to 36,000. 1,20,000 minus depreciation is equal to 84,000. Written down value for tax purpose, we have 50,000. 50,000 minus its 30% depreciation, 50,000 into 30%, 15,000. So written down value for tax purpose, 50,000 minus depreciation, that is equal to 35,000. Then temporary difference on 31st March 2018 is equal to 84,000 minus 35,000, that is equal to 49,000. So deferred tax liability is equal to 50% of that 49,000, that comes to 24,500. So in the year 2017-18, we have reversal of deferred tax liability, that 35,000 minus this 24,500, that is equal to 10,500. Then journal entry on 31st March 2018. First entry, deferred tax liability debtor 10,500 to deferred tax income 10,500. Then our second entry, deferred tax income debtor 10,500 to profit and loss account 10,500. That is all about our accounting for tax. I think this session is clear for all of you. We will meet again. Until then, goodbye.